Here's the market update and the weekly outlook for this upcoming week. So today was one of the most consequential single trading days that we've had in a very long time. And I also want to build the full picture for you guys very carefully before we get into the setups, because right now in the markets, we have five separate forces that have moved simultaneously today. And so understanding how they connect is what is really going to separate a disciplined trade from more of a reactive one. And we're going to see a lot more of the reactive trades throughout the week as we're getting more data points, as we're getting more headlines, as we're getting more reactions, and we have more earnings that are coming out. So let's start off with the geopolitical layer first, because it's the dominant variable governing every single instrument that we're looking at today all across the board and the remainder of the week as well. The US has conducted its 10th consecutive day of airstrikes today against Iran. 3 American service members have been killed in the past 72 hours, 2 in Jordan, 1 in Iraq. And Trump responded with a social media post right here saying that Iran will pay for that killing many times over. CENTCOM also confirmed that the latest wave of strikes targeted military command centers, maritime capabilities, and air defense systems across Iran's southern coast. So that's 10 straight days of bombing, 3 soldiers that are dead, and a US president whose political calculus basically has now just hardened materially. And simultaneously, this morning, we also saw articles around Iran's foreign ministry confirming that mediators have conveyed ceasefire proposals to Tehran. And Pakistan's army chief was in contact all night with Vice President Vance, Witkoff, and Iran's foreign minister as well. A framework called the Islamabad Accord was passed over to Tehran, proposing a 10-day halt to restore the June interim deal. Secretary of State Marco Rubio also said that Iran is still sending signals that it wants to negotiate. The Iranian interior minister traveled to Pakistan today as well. So here is how to read that contradiction, because as I have mentioned many times in our market updates, in our live sessions, and even during the weekly outlooks, that it's one thing to read the headlines, but it's another to really understand what's happening between the lines and the contradictions and the oscillation patterns that we have. And that is really what is separating profitable traders versus unprofitable traders who are getting stuck, becoming wick rejections, or just becoming, liquidity in the markets, basically. Because obviously it looks like that both things can't be true at once that we're looking at, but they can, and they are. So this is what conflicts looks like at the resolution phase here. The fighting and the talking, they're both happening simultaneously and for months at this point. Each side uses military pressure as leverage in the diplomatic track, and it's not really using it as a replacement, right? The market understands this dynamic already. We have been seeing this for 6 weeks now. US oil has hit its own high in the last couple of days, really since June 12th. It came back up and tapped right into 84.60. Intraday level, highest once again since June 12th. We had a nice drop coming back below the 70 level and then a retracement back up bullish, right? And then after tapping into those highs, it has retraced back down into around 79, 74, but holding on to a pretty strong support level above the $80 mark. And that is as the ceasefire signals are starting to soften the buying here, right? So that intraday swing that we're seeing from the peak to the settle point that we're looking at right now is the market pricing maximum military fear already, and then partially pricing diplomatic hope, and then finding a middle ground. The settle that we're seeing here around these support areas, around $82 and even $81 here, is the market's best estimate of where oil belongs when, soldiers are dying and mediators are simultaneously in flight at the moment. But here's where today basically got materially worse for energy markets all across the board, whether you're trading WTI or you're trading Brent. And this is the development that most traders haven't really fully absorbed just yet in the market. And that is Yemen's Houthi militants formally declared a maritime blockade against Saudi Arabia, effective immediately. So that's not just a threat anymore. This is a declared formal action that's in play at the moment in the markets. And the reason why it changes the entire oil risk framework that we're looking at in a way that's structurally more significant than anything that's happened since the ceasefire collapse on July 8th is that when Hormuz disruptions began this month, the world basically found a workaround. Saudi Arabia had rerouted millions of barrels per day through its east-west pipeline to the Red Sea port of Yanbu, bypassing Hormuz entirely. The UAE found a bypass to the Indian Ocean. These routes through the Red Sea and sorry for the mispronunciation, but Bab el-Mandeb became the safety valve that prevented a complete global supply crisis, even as Hormuz dropped to about 45% of pre-war transit levels. The 7-day moving average of Hormuz barrel flow already fell from 9.4 million barrels per day to about 5.5 million. Saudi Arabia's Red Sea pipeline was already compensating for that approximately 2.5 million barrels of that lost flow on a daily basis. The Houthi blockade is targeting that safety valve now directly. So that's why it's so important for the energy markets. If Saudi Red Sea exports are choked at the same time that Hormuz is basically closed or functioning closed at the moment, the results are even more severe. The consequences are even more severe. And Goldman Sachs also, let's come back here. Goldman Sachs has also published a note today confirming that their $120 Brent scenario for Q4 if disruptions continue to persist here. And that note was written before the Houthi blockade was formally declared. So Goldman's base case here remains $80 by Q4 on a de-escalation assumption, but they explicitly said that risks are tilted to the upside. The volume of Saudi oil directly exposed to the Houthi blockade is roughly about 2.5 million barrels per day. For US oil specifically, since that is exactly what we trade in the group, the pathway from sitting just above $80 mark or 82 up to 85 to 90, it's a straight shot, right? It's even now shorter than it was about 48 hours ago. And a dual choke point scenario here with Hormuz plus the Bab el-Mandeb simultaneously disrupted is the event that puts WTI or US oil back up to the $100 levels that we have been trading right when the ceasefire, right before the ceasefire was announced and during the war times, right? It puts that print right back onto the table. So US oil's range this week is going to be quite binary that we're going to be looking at. Already we are starting to see, if you go back up to the daily timeframes or even the weekly timeframes, where you have a pretty nice range, but if you look to the left, how significant these levels are. You're sitting right above a weekly consolidation. The exact level that price is sitting at right now was previously a resistance as well. Confirmed Iranian acceptance of that 10-day ceasefire proposal will send WTI or US oil back below the 75 to around 70 levels and even potentially closer to the 68 level. And it's going to strip the war premium built over the past 2 weeks. A confirmed Houthi interdiction of Saudi tankers, so not just a declaration, but actual interdiction here that we are going to see, will send US oil through 87 and towards the $90 mark. So do not take outsized directional positions here in US oil until one of those two events is confirmed, right? You don't want to be hopping it into swing trade opportunities or anything like that, but you still have great scalping opportunities and day trade opportunities, and we're going to take a look at that on the technical side. Now, let me give you the second new development that really no one was positioned for about 24 hours ago, and that was Trump, right here. Trump imposing 50% tariff on selected Canadian goods under a provision of the 1930 Tariff Act that was never used before. So we're talking about milk, hockey, equipment, beer, plywood. So targeted, very specific categories that we're looking at. Energy and critical minerals are explicitly excluded here. The Canadian dollar also was obviously affected by that. It dipped, but then it ended up recovering after that. The market is reading this more like a targeted escalation rather than a broad trade war, which is the correct institutional read, given the energy prices represent 38% of Canadian exports to the US and is specifically exempt here. The reason this matters for the things that we're trading or the pairs and the assets that we're trading is that it's not the Canadian dollar directly, it's the inflationary input here. Things like plywood and building materials from Canada feed right into the US housing cost. Dairy feeds right into the food prices at the grocery stores. So these are small in aggregate, but they do add to the overall inflationary picture at exactly the moment when Fed is now trying to determine whether the June data points that we had, whether June's deflation was just the beginning of a sustained disinflationary trend or a 1 month artifact of the ceasefire. We had already talked about the CPI data points. We talked about NFP data points and everything like that from June, how those were pricing in that ceasefire. But right before we had that data point coming out earlier this month, we also had that ceasefire being disrupted, or basically the ceasefire just falling through on July 8th. So we were already talking about how this is more of a one-off situation, and the data points will not be fully reactive of what's happening in the current market conditions. So every incremental inflationary input will matter here a lot more, especially going into next week when we're going to have interest rates coming out again. So now before we move further ahead, let me just connect those both geopolitical stories with Iran and Canada to the Fed's position, because now this is where the macro picture is going to become a lot more important, especially depending on what assets that you're trading. The Fed it's in mandatory quiet period this week. There's going to be no speeches, there's going to be no interviews, and no Fed speakers until after the FOMC meeting next week. The last public communication that we got from the board was explicitly hawkish. And we had a lot of FOMC members calling for higher rates as of just last Thursday. So that hawkish anchor still remains in the market. It's very much live. But with no new Fed communication, the dollar and rate market are now entirely dependent on oil prices and Wednesday's earnings for directional input this week. We're going to get to the earnings in just a little bit. So the specific transmission chain that we're looking at is US oil sitting right above that $80 mark, between that $82 and $85 very specifically, is going to feed into July CPI, the data point that the Fed will basically have in hand at the July meeting. The June CPI was deflationary because the ceasefire had brought gasoline down, right? Below the $70 marks, closer to the $68 marks. The disinflationary relief that gave the Fed breathing room last week is now partially reversed by the time that July CPI data points drop in August. So the Fed knows this. The FOMC quiet period does not mean that the committee has now stopped watching oil. It just means that they're watching it silently. And whatever they see is being incorporated into the decision making without any sort of public commentary. We are used to, especially with Powell, getting more comments, getting more Q&A, getting more clarity on where the Fed is headed depending on different situations. We're not getting that under the new regime anymore. So that's why the market is going to be a lot more reactive. The dollar's behavior this week is going to reflect that dynamic very precisely. If you look at DXY, so let's pull up the chart here, or if you look at any USD pairs in general too, come back here, you're seeing a lot more consolidation, a lot just more the dollar holding its defensive bid from the elevated yield and the oil-driven inflation expectations, but without a daily hawkish Fed speaker to reinforce that bid, it's going to continue consolidating. When you're looking at Euro USD, when you're looking at GBP USD, and when you're looking at the yen pairs, that means that the dollar isn't really providing any strong directional pressure in either direction this week. So the pairs are being driven by their own domestic stories and by Wednesday's earnings risk instead. So when we're looking at very specifically the currencies, let's start off with Euro USD, you see that price is continuing to consolidate here. You're seeing that on the 1 hour time frame, price, or even on the 4 hour time frame, how price is just consolidating below these areas of these weekly support levels as well. If you come back onto the weekly time frame, right around here, you have your support level sitting around, I would just say 1.145 area, right? And the ECB flash PMI data is also going to be coming out on Friday, which is going to be another catalyst. So let's pull up this week. So we have PMI data coming out from the entire Eurozone. So that is going to be another scheduled Euro catalyst that we're looking at. We have an ECB split right now as well, right? Where we have some members who are saying that the peace deal doesn't restore pre-war conditions and gas prices are still about 40% above pre-war levels. And then we have more dovish members instead And that is the ongoing Euro uncertainty that we have. If the Iran de-escalation is confirmed and oil falls, the energy calming scenario that a lot of the dovish members have been using as their basis for a potential July pause is now going to become a lot more credible, which is mildly Euro positive here. So until that confirmation comes, we're going to see that Euro USD remains in its short-term downtrend, as we have been seeing some relief here as well. And with resistance, right, with price sitting closer to that 1.1, almost 48 level, down to around 1.146 level as well, right? And the downside target being closer to just 1.14 level, coming back into these support areas on the weekly time frame as well. When we're looking at GBP USD here, GBP USD currently sitting closer to that 1.344 area. It's carrying that UK political transition here as well. Andy Burnham officially became Prime Minister today. His surprise choice of John Healey, the former Defense Secretary, as the Chancellor of, or the new Chancellor basically, introduced an unexpected variable for the sterling. The markets had been expecting a more orthodox or economic appointment here, but the pound still held its declines from the bearish pressure that we have been seeing if we come onto the daily time frame. So we continue to get that bearish pressure today as well. So the 7 weeks of political stabilization premium that drove the sterling's multi-day winning streak earlier this month has now basically been fully delivered. So we're going to watch here if price can continue holding on to this 1.344 or 1.343 area right here and continue pushing back up through the London Open and even going into New York Open tomorrow. Or whether the sell the news pattern, which is the anticipated catalyst delivered, buyers who bought the anticipation now confirming or selling the confirmation, is going to be the more dominant play here. When you're looking at USD JPY, it's currently sitting above that 162 level, 162.5 level here almost. So it's still near the 40-year historical extreme. The FOMC quiet period removes a daily dollar bullish input, which marginally reduces the rate differential pressure on the yen. But the structural driver still has not changed here at all. The US-Japan rate gap still remains pretty wide. The new development from the Japanese bond market data also published overnight, where the Japanese life insurers bought the most super long government bonds in 3 years in June. And we have that right here in this article. And so we saw that about 630.5 billion yens of bonds with maturities over a decade is what they have bought up. When Japanese domestic institutions are now actively buying long duration local bonds at these yield levels, the structural incentive to fund overseas assets through yen borrowing, that is your carry trade mechanism, right? And that becomes marginally less attractive now. So this is not just quote unquote this week intervention catalyst. It's more of a structural force that makes any BOJ or the Ministry of Finance intervention more likely to hold when it does arrive. And that's what the market is still preparing for. That's where a lot of the fear is coming in, especially for a lot of the yen pairs, because the fundamental capital movement that we have been seeing here, it's beginning to support the yen, and it's not just verbal jawboning at this point. On Euro JPYs and GBP JPYs, mainly we have been trading GBP JPY here. Both crosses inherit that USD JPY intervention risk, compounded by their respective base currency stories as well. So these remain the highest velocity pairs on any intervention day because both sides of the cross will move simultaneously. So in a week where the Fed is silent, Iran is binary, and Wednesday is a massive earnings catalyst, the yen crosses do actually deserve a lot more caution in terms of position sizing. I am personally staying away from these this week. So any of the yen crosses, GBP JPY, USD JPY, Euro JPY, I'm just staying away from them. Now, let's take a look at what is happening in terms of equities. Let's tie that in, especially with our US 30, NASDAQ, and Russell, which is your small cap. So today's Asian session told a very specific and more of an instructive story as we come back over here, where institutional money is basically and actually positioned. The Asian equities rallied sharply overnight, and South Korea also gained more than 3.5%, mainly because of Samsung and TSMC being the two biggest contributors here. And we have been seeing that NASDAQ obviously had a massive drop in the last couple of days, but that was because it got dragged by South Korea stocks as well. So what we're seeing here very specifically is mainland China's tech also jumped about 7% as state-linked institutions mobilized to prevent further tech selling. U.S. equity index futures also had pretty nice sells this morning that we got to take advantage of with these. Let's come back to the 4-hour time frame. With some pullbacks that happened, starting with last Thursday, and then price starting to consolidate into these areas, but we had some sell opportunities later into the session as well. But now NASDAQ very specifically rising back up almost 1%. So the question here is, why did Asian tech rally on a day when geopolitical risk objectively got worse? With 3 soldiers that are dead, Houthi blockade declared, U.S. oil touching closer to the $82, getting closer to the 85 range almost. And the answer to that is because the market has already sold the fear. NASDAQ already fell almost 4% from its 10-day peak. Semiconductors already corrected 14% from their June highs. The AI infrastructure trade was already beaten down for almost 2 weeks straight now. So the institutional accumulation data that we have been tracking all month, where we saw 50 million in Google deep in the money calls placed at the ask last Thursday, and 6 long-dated NVIDIA call sweeps, multiple funds buying TSM directly on the dip. It's already built into a correction, not just a peak. Asian markets are now looking through the geopolitical noise towards Wednesday's Google and Tesla earnings as the fundamental validation point for those accumulated positions. So let's bring this up here. So this is what's happening when it comes to the options market, and looking at just the institutional flow, looking at what's specifically happening with pre-positioning as well. And very specifically, if you're looking at Russell, which is your small cap stocks, we see that over here very specifically, it has dropped back down from its 10-day peak as well, right? And we have a nice bearish retracement coming back down, even based off the weekly time frame, setting up a retracement from the peak level right here. Small caps are now underperforming both S&P 500 and NASDAQ from their peaks, down about almost 2% versus NASDAQ's just 4% decline, which tells you that the selling has been concentrated in high multiple tech rather than the broader economy. And the small cap or Russell 2000's relative resilience is the clearest real-time confirmation of that rotation thesis, that money is leaving long-duration tech and it's going into value, financials, and small caps. When we're looking at this data point here, you can see all the unusual options and the key flows and everything like that. But very specifically, we also see a March 2027 small caps $320 call position, which is about 251 days out. And it's being held by institutional money that's betting on a small cap recovery tied to an eventual rate cut cycle. So that is the medium term setup here. The near term setup for the small caps this week is going to be Wednesday's earnings. If Google and Tesla confirm that AI demand and corporate earnings resilience, then that positive sentiment will broaden out to the small caps here. Now, very specifically looking at with the earnings framework for the week, because this is the week that's really going to determine the Q3 direction as well. So let's continue down. So these are all the insider trading and all that stuff. But here's the earnings this week. So we have tomorrow's pre-market earnings. It does say today, but this is for tomorrow's. We have GM, we have 3M, we have Northrop Grumman, we have a bunch of other stocks that are basically releasing their earnings, right, in pre-market. So a lot of these are the setup sessions here. So when we're very specifically looking at HAL, This is very important because as an oil field services company, it has a direct revenue correlation with the elevated US oil prices. When we're looking at, let's come up here. Yep. When we're looking at this stock very specifically, this one will be read against Iran's status, war premium, and defense names as they continue to unwind on ceasefire or they hold on escalation. Capital One and IBKR are the consumer credit and the financial market signals. So that's what we're going to be watching out for. Then we have on Wednesday, Google and Tesla, which are going to be very important as well, are actually the most important because Wednesday is more of the week's defining event here. So they're going to report after the close. First is going to be Google, and then it's going to be Tesla. For Google, the earnings per share estimate is about $2.87. That is up 24% year over year. Revenue is 113 to 117 billion. The single most important number is going to be Google Cloud's revenue growth rate. The estimate is roughly around 60% year over year. That's the AI enterprise adoption rate for the entire market. A 60% or better cloud growth rate will confirm the institutional conviction behind that 50 million in the money call position placed at the exact moment of maximum negative sentiment placed last Thursday. Additionally, Google today was reported to be developing another proprietary server chip called Frozen V2 to optimize its Gemini model and potentially deployed as soon as 2028. So this directly addresses the competitive threat narrative by showing that Google is building its own silicon stack, and the Gemini delay is basically an execution issue here, not more of a structural collapse of the AI business. That's what the market was already reacting off of, the Gemini delay, as soon as that announcement came out. For Tesla, record 480,126 deliveries in Q2. EPS consensus between 36 cents to about 54 cents. Option pricing in of 7.6% swing. The variable is going to be the automotive gross margin here. Heavy promotional pricing has already been compressing profitability. Margins above 17% will validate the cybercab and AI repositioning story. Below 15, the valuation at 349 times earnings will become very difficult to defend regardless of whatever the delivery count will show. Thursday brings in some more defense earnings, which will read directly against Iran's status by then. Now, when we're looking at the institutional positioning that brings the entire picture together, the options structure is skewed bearish in the near term. S&P 500, about $740 to about $750 put wall will hold nearly 126,000 contracts of combined open interest at the 10-day expiry. The call side is effectively dead above the $760 mark. So that is insurance. That's not giving us any sort of directional conviction here. So please don't misread that. That is a very common mistake. The institutions are basically hedging at the $740 to $750. They're not betting on a crash here. They're protecting existing long positions against a specific scenario where Iran rejects the ceasefire proposal and Wednesday's earnings disappoint simultaneously. So that double negative scenario is what the put wall will ensure against. Simultaneously, if you look at the 13F institutional flows, so let's come back up here. Right around here, it shows that we're getting a lot more accumulation. Microsoft and Google and Meta and Nvidia and Texas Instruments and UNH and LLY and TSM and NASDAQ passive ETFs. 91 UK bought more than $420 million worth of United Health. Korea specific call flow where you have a $9 million in EWY January 2027 calls. That is a signal of institutional conviction that Korean tech will recover in the medium term. So that two-book strategy is running exactly as described. You're hedging the near-term fear, you're accumulating the medium-term opportunity. So selling puts equals being willing to own at lower prices. Buying calls equals expressing conviction for later in the year. Retail also here is mildly buying the NASDAQ dips. while selling S&P 500, the small caps, and the Dow Jones. Apple sentiment or retail sentiment is currently sitting at -10 to about -11, very specifically as well. And that is the most extreme fear reading in the data set that we have so far, while institutional 13F data shows multiple funds accumulating Apple in size. So the retail institutional divergence is pretty wide here, as it's been all year, and it starts to narrow when Wednesday's earnings will confirm or deny the fundamental thesis here. So these are the bigger picture of how you're seeing capital rotation when it comes to equities, when it comes to currencies, when it comes to commodities, and how all of it really started from the US and Iran war. It trickled over into inflation. It trickled over to what's happening with the energy prices. Or whatever's happening with the Fed. And then also you're starting to see how all of that is trickling down into specific sectors within economies, right? Within our economy, whether it's tech, whether it's just the AI narrative and the conversations around, is this just a bubble that's waiting to be burst, and all that type of stuff, right? As we're getting more earnings, showing you what's happening on the retail side as well and the manufacturing. So it's very important to understand what's the holistic picture, especially right now as we're trading indices, commodities, currencies, all at the same time, and equities here as well. So let's jump over to the technical side, and then we will talk about some risk management for this week as well. So this week, we already have a bottom wick rejection. So that is our support level, which is going to be 51,800. You've got your top wick rejection up top here at 52,400. Drop down to the daily. So on the daily time frame, we have broken below the previous support areas. We had a massive wick rejection here, and we have closed below that on the previous daily candle as well. If you look to the left, this is a very strong support level and a previous all-time high before we got a corrective move and then a continuation back up. So overall, 51,800 is a very strong level, and we have to be very careful as we're looking for any trades. Now, off of the daily time frame, I also see a resistance formation here. I see how that is shared from the next couple of daily candles as we get closer to the current daily candles here as well. So if price breaks above this, then I drop down to the 4-hour time frame. I see a bounce off the 4-hour time frame. I see a ton of consolidation here. So as price continues pushing back up bullish, let's say it's a bottom wick, or even going to London session or New York session, I'm looking for those buying opportunities to come back up, first of all, into this support, which gives me around 200 points, around 220 points to catch, and then ultimately coming back up into that 52,400 to give me a total of around 400 points, almost 400 points here. If price continues to just tap into this area, let's say it comes into the previous support and then bounces back up or bounce back down, creating those lower high formations as we see from up top here, where you had your high, lower high, lower high, lower high, lower high, and if you end up getting another one, somewhere around here, and then a drop back down, you still have great sell opportunities that you can take from up top here. The point being is that you have to be very careful because you also have, let's come back up here. Today's was quite an easy day, but you do have a lot of fundamentals that are coming out throughout the week, not very specifically for US 30, but on Wednesday, you do have a lot of earnings that are coming out. Throughout the week, you have a ton of earnings that are going to be coming out. So there's a lot of pre-position that's already happening. There's already the market looking for any take profits and things like that. So you want to be extremely careful here, right? So the overall summary here, even for the market regime, if you're looking at the market sentiment, is cautiously bearish near term. So you have to be careful here instead of just jumping into these trades, especially with US 30. Even if you're scalping, you need to wait for your proper confirmations prior to an entry. If price is not able to break above this, you do not have any buy opportunities. Sells are only going to be valid if price continues to hold on to a resistance here, but even then you only have a small little range to come back down into 51,800. This is a very strong level from the weekly time frame and the daily time frame and the 4-hour time frame. So just a 15-minute break here or 30-minute break here is not going to be sufficient for you to continue to look for those sells for a complete meltdown. So it is bearish near term, but you need the fundamental catalyst to help you continue breaking below these strong levels. Then we come over to NASDAQ. And on NASDAQ, you see that price once again last week created a nice bottom wick rejection. We have rejected off of that, but overall, we have just been in this pattern of just bouncing off of the support and the resistance and just looking for a zone to zone trade. So last week is the first time we really closed below that consolidation level here. What we want to be careful of here is making sure that price doesn't just end up pulling right back up into that area of consolidation until, Wednesday or even going into next week with interest rates and all that stuff that's coming out. So that is our support that we're looking at the moment. For this week, right now as well, what I'm going to do is map out the current top wick rejection for this week, which is also the previous support area for that consolidation, which is, I'm just going to call it 29,000. Come down to the daily time frame, a very strong previous support area. Previous daily candle closed with a top wick, barely a bottom wick here, but still closed bullish. The current daily candle already created a bottom wick, pretty much equal lows, and it's starting to push back up bullish. Same exact thing as US 30. This is a range that we want to be careful of. If price breaks above this, then we're looking for a zone to zone trade. You're going to be targeting the next area of around 29,600. So that gives you a 600 point move to the upside to target right up top here. If price can continue pushing back up bullish, right? If price rejects this and pulls back down, then you're coming right back down into 28,275. Drop down to the 4-hour time frame. You see that even here, it tried to continue pushing back up bullish, but you don't have enough buyers in the market to give you that close, that strong close with conviction to the upside. So that tells you that you have to wait for your setups here. You don't want to force a trade. You're just looking for a zone to zone trade. So here, price has obviously clearly rejected off that resistance areas. If I want to look for sells, I would wait for price to drop below this. So then that way, at least I have a clean sell coming right back down into 28, almost 569 or 570 area. So you still have about 200, 300 points that you can catch to the downside. But that is only possible if the candles close below the range like it did here and then a continuation down to tap into this area. For any buying opportunities, then you're looking for buys above 29,000. Now we have our small caps here with Russell, and you have your bottom wick rejections. This seems more like a early stage move with NASDAQ, how it was consolidating here. Kind of a similar setup where it's consolidating here, and you have your top wick rejection into the resistance areas here. I'm going to call that 29.90. Drop down to the daily time frame, and on the daily time frame you have this previous support, current resistance. If price can continue breaking past that, then you have your buy opportunities. Anything below it, you can see how there's messy price action. So you're just looking for buying opportunities above that, or drop down to the 1-hour time frame, let it hold on to a resistance, continue dropping back down bearish, and you have your sells below this. So that way you're out of this consolidation completely, and you get to catch yourself to come back down from about 29.53 to come all the way down closer to around 29.46 area and a little bit more too. Now we have our GBP USD. We've already talked about the fundamentals for this too, but you can see that it's sitting in a multi-week consolidation here. You have your top wick rejection, 1.348. And instead of mapping out the current weekly candles bottom wick, I'm looking at the support area here, and I'm going to map that out. And that is my 1.34 area. I drop down to the daily, and on the daily time frame, I see a ton of consolidation here, but I do see that there's some opportunities for a zone to zone trade. But that is only for a scalp. But looking at all the pairs that we have available with the movements, I think you do have a much better opportunity to look for a scalp on these other pairs. So far with the equities, gold, oil, and we'll take a look at the rest of the pairs here for the currencies too. But this and your USD, I'm still keeping that for my swing trade opportunities here instead. So even based off the daily, we don't have much of a direction here just yet. So I'm going to drop down to the 4-hour time frame. And based off the 4-hour time frame, I see that we have a previous support, current resistance right around this area. And if price can continue pushing back up bullish, then you have about a 32 pip range. If price breaks above that 1.348 area here though, then I have about 77 pips that I can catch to the upside, and then a continuation back up bullish, which is going to take you up to about 100 to 150 pips that you can still catch. So once you catch those 77 to 78, then you're coming back up around 160 pips that you can catch. If price continues to drop back down bearish, and let's say it breaks below that 1.348 area, or 1.34 area actually, and continues pushing down, you start off with 53 pips, continuation down for 60 pips, you got 76 pips, and then coming back down into the next major support where I see bounces off of is about 183 pips to the downside. So those are my swing trades that I would much rather catch on this pair. Coming over to Euro USD, it's quite similar to GBP USD, but here we're starting to see much clearer consolidation right into the support area. 1.38 resistance with those wick rejections, which is sitting right underneath that support area here to the left. Weekly is consolidating. That tells me right off the bat I don't even want to drop down to a lower time frames because I know that this is going to be my swing trade opportunity. If price does break above this, I'm looking for buys to come back up to about 140 pips and then continuation back up, zone to zone trade basically for about 300 pips and a continuation up for about 390 pips. If price drops back down bearish and it comes back down to filling this wick, I still have 300 pips in either direction. But even if you drop down to the daily, you're sitting in the middle of the range. So that's why I would much rather wait for price to break above or below these levels and then look for swing trade opportunities there. I'm staying away from yen pair, so I will not be analyzing those. But let's come over to gold. I have my weekly bottom wick rejections here for the last couple of weeks here from June 22nd. I look to the left. That's another major support level here too. That is, let's just call it 39.60. And then I also have the previous weekly candles open and a bit of a gap that the market has still not filled in. So I'm going to create that as my resistance because the current weekly candle also does not have a top wick. It's currently sitting at the top of its range. I'm going to drop down to the daily time frame. I see a ton of consolidation here, but gold is a lot more volatile, so you still have opportunities for your scalp opportunities regardless, and even day trades. Drop down to the 4-hour time frame. This is where you narrow in your zones. So this is the level here. If price can break above this previous support, resistance, current resistance, then you have those buying opportunities to go back up into almost 4,091.4 area and just a little bit higher to fill in that gap here as well. And if price rejects this, it holds on to a resistance. I would still not look for a trade unless price can break below this support area, comes back down. Then you're going from around 4,025.8 down to below 4,000 level here, basically into 39.98, and then further down into 39.60. So that would be my level. You might get this move potentially going into London session or even into New York session. Now we have silver here. Silver has also bounced off of a support level on the weekly time frame. It has not even tried going bearish with the current weekly candle, currently sitting at the top of its range. Also, we'll be mapping out previous weekly candles open where you had a little bit of a gap. Drop down to the daily. So on the daily time frame, you got a nice bounce off that support. Price is pushing back up. Still going to map out this level here. As long as price is above it, we have those solid buys. You got a nice 4-hour candle closure above it. With this new 4-hour candle that just started forming about less than 30 minutes ago, you want a bottom wick rejection, flip back up bullish, and you got your buy opportunities to the upside. If price pulls right back down, I'm going to drop down to the 1-hour time frame. If price pulls back down, I would want price to drop below this level. Then I look for myself to come back down to the previous support. If it breaks that, it has broken this bit of a corrective bearish push. And then you have those cells to come back down into the weekly support once again. Now with oil, I'm just going to create a line at the $80 mark because we know that is the turning point. $80, if price is sitting above $80, we have already talked about how that is the market pricing in the energy prices pushing back up bullish based off of the uncertainty around the US and Iran war and trying to see what happens with this proposal here now, if we end up getting that ceasefire, that 10-day proposal or not. And if we don't end up getting that, then we remain above 80. 85 is the main target because that is where we're going to expect that escalations are happening and we're going to see more fights and all that stuff. And talk's really not going anywhere. So remember the simultaneous things that we talked about, that there's negotiations and there's military actions are still in play at the moment, right? So if it breaks above 85, straight shot up to 90, and then $100 is really where you're at peak wartime and the market has new information to price in. At this point, the market has already priced in maximum pain so far. But if there's anything worse than what we have already experienced, that's where you're really expecting price to tap into the $100 mark. But as of right now, this is our range. We talked about the binary events and the triggers as well, right? The fundamentals. So that's what this range is playing out with. And that's why you don't want to be looking for swing trade opportunities, but you do have great scalp opportunities or even day trade opportunities. So based off the 4-hour time frame, I can see that price is holding onto resistance here. If it breaks above, let's say this $80 to $70, then we're pushing back up into the $85 mark. I also see that price is tapping into the same exact support area and creating wick rejections right into this. So if it breaks below that, let's say we get a little bit more optimism or the market has already fully priced in the uncertainty, it's looking for a little bit more relief, potentially coming back into a previous consolidation, then you look for those sells to come right back down. So that is the full fundamental market sentiment technical analysis for all of our pairs that we're watching this week. Now, talking about the risk management framework for the week. Today and tomorrow are more of the position sessions. So we will be operating at 1% risk. We're going to be observing what happens with Iran's formal response. We're going to let Tuesday's earnings with GM, 3M, Northrop, and a couple of other basically inform the macro backdrop without really forcing any sort of trades there. Wednesday is the week's binary event. So protect your capital through Google and Tesla prints. Size for the confirmed post-earnings direction rather than the pre-print guess. Thursday and Friday are the management days. You're going to extend out your winners. You're going to scale down into Friday's close for the weekend gap risk that has basically existed every single Friday since July 8th. The single most important sequence to watch this week in order is going to be Iran's formal response to the 10-day ceasefire proposal. This is the oil and risk sentiment binary. Whether the Houthi Saudi Arabia blockade or Saudi blockade produces actual interdiction of vessels versus a declaration that isn't really enforced, that distinction is that $5 to $8 move that you're expecting on US oil. Then Wednesday's evening, you have Google and Tesla reports, the fundamental confirmation whether that either is going to validate the institutional accumulation or extend the correction. So just stay patient. The setups are pretty clear. We're getting very close. There's a lot of consolidation that's going on, and the confirmation has not landed just yet. I will see you guys for the Wednesday live session at 6:30 a.m. PST right here on YouTube again.